All right, the recording has begun, and it is August 29th already. Hard to believe. Days are getting shorter, and it's about just a little after 2:30 Eastern Time, 12:30 where I am here in Steamboat Springs. I'm Tim Quast. Thank you for joining us, and with me is Henry Howard, Head of Client Services, and we're going to take you through some hopefully helpful points about using Market Structure Edge. So I'm going to share my screen. Here we go. Get all that out of the way. There we are. Okay, so first of all, and Barry, all you veterans, bear with me for a moment. I'm going to talk again about I like to talk about broad sentiment, context, divergence, because I think about them every day. Every day, first thing I do is I like data, so I can't wait to see what the data indicate each day. So I go to my, here's the dashboard, the Edge dashboard, and the first thing I look at is broad market sentiment. And that's what we say, BCD, broad market sentiment, context, and then where are the divergences? And periodically there are opportunities to short. And, Barry, you're good at this. For a lot of us, very difficult to do. I've certainly lost money trying to get that timing right because it's difficult to do. The market has a definite upward bias because there is too much money chasing too few goods. No question about it. Now, if you look at, I'll give you an example here and then come right back to this. I have this mega caps portfolio. All I do, by the way, is just I search for market cap equal to $100 billion or more. Right? So just so the largest part of the market. And it's amazing that 118 there are 118 stocks currently that have 100 billion or more in market cap, and they're 42, almost 43 trillion dollars. Well, divide total market cap, I call it about 55 billion or 55 trillion in the market, and you'll see that it's like 78% of the market cap is in those 118. It's about currently about almost 90% is in the S&P 500. So the market is concentrated in large stocks. It cannot sustainably shift to small caps and utilities or whatever. There isn't enough market cap to accommodate the massive amounts of money at BlackRock, Vanguard, Fidelity, State Street, UBS, Credit Suisse, JP Morgan, Morgan Stanley, all these firms with close to $48 trillion of assets under management. So that's what you want to know. I mean, you want to look, well, what is all that money doing? Well, the first thing I look at is what's broad sentiment doing. When it goes above this red line, the market has a propensity to stall or fall. Doesn't always, but most of the time it will. Here we went for a very long time at 5, and then it finally caught up with us. And is this derivatives driven? Well, it happened right around options expirations. We had a steep short covering event around July. Options expirations in the market, but not in tech. It was the reverse in tech. If you go look at that, it was a bunch of shorting in tech. But you could go back and look historically, and when we get near the red line, we know that there may be an opportunity to short. It doesn't come along that often, particularly when we shoot over the red line to a level like where we are now. This is, back here in July, we were at 7.3 on a 10-point scale, and this is 500 stocks averaged. So that's a pretty high number. And currently we're at 7.1, peaked at 7.2. I don't know what's going to happen. Sometimes the market continues on. If you backed up, let's see, I think if we back up a year here, it's, here, we had a monetary policy change, the end of the rate hike era. Well, that created momentum. Money came rushing in, and we had a double top right at the red line. But sooner or later, that's going to change. And you look down here, this clearly was a massive momentum market because short volume, the supply side declined, and we had a massive surge in demand. Well, what's that going to do for stocks? It'll have a long contrail. It'll carry it a while. Then things change. But every time that we get to the red line, it causes the market to slow down in some fashion. It even happened here. The market flattened out. Then we took off again, went up. Then we peaked and began to decline, market flattened out. So it doesn't mean that the market will fall. It depends on what the conditions are. Do we have momentum or do we not? Look at where we are now, and we'll talk a little bit later about what's ahead. Look at this big change. We've gone from a steep period of short covering, insufficient supply well below trend, and that has been very helpful to the market, to what we have a level that is well above the 1-year trend now, and staying right at 50% of the market. I don't know what's going to happen. I just know that this data tells us that probably we are peaked. And you say, well, Quast, the Dow's up 500 points today. What are you talking about? That context. Context is very important. You can't have one without the other. You can't look at broad sentiment and then not look at the context of the market. And this is the way to get there. You hit how it works, and this will take you out to Market Structure Edge. And go look at the calendar. It's not the only thing that matters. You've got all kinds of things that have become tradable. There are Fed meetings, the key economic data points like GDP today, 3%. I don't believe it. I don't think that you can back 800,000 jobs, wind the clock all the way back to where we were in February of 2023 level of employment. That's what you would get if you back out 800,000 from the running total. And we have a consumption-driven economy, as all developed economies are. That the growth of the economy depends on people getting jobs and spending money consuming stuff. That's how you get economic growth. If we back out nearly 1 million jobs, did the economy grow 3%? I doubt it. Those things probably get revised, or sometimes that data is just inaccurate. So you got to keep your common sense around you. But this calendar will look at derivatives expirations. And we're concerned principally with the monthlies because these are used for hedging. The biggest hedging instrument in the equity market now are month-end index options. Big passive portfolio managers will use baskets of those to true things up. If you have an index that has Dollar General and Best Buy in it, man, you're way off. So you're going to have a basket of futures that true you back up to the index, the measure that you're supposed to track. Well, that happens on days like today. So when you see a big day like today and month-end index options expire tomorrow, there are trillions of dollars pegged to these things. The CBOE launched them in 2014, Chicago Board Options Exchange, in response to the explosive growth of index investing and the clamoring need for, we need a way, because I don't want to have to go buy fractions of hundreds of stocks. It's very inefficient. It's very expensive. There are tax consequences. Give me a basket of derivatives, some index options and futures, and that will get me square. So it's become a very big deal. As BlackRock, Vanguard, and State Street get bigger and bigger and bigger, these things become a big deal. So we can conclude today that there's a lot of focus on blue chips. The Dow is the outperforming piece of the puzzle. It's probable that there's a big demand for those things because they tend to guard against volatility. September is, believe it or not, the worst month. We tend to think of it as October. Historically, over the long term, and do I care that much about antecedents? I care about antecedents from 2007 to present. Why? Because that's the market that exists under Regulation National Market System. That is apples to apples. Anything before that, different regime. It's a different set of rules that govern how trades execute and how the market behaves. So that matters to me. But September, people prepare for volatility. Does that mean tomorrow's a bad day? I don't know. Who knows? But there's a high probability I might. Yeah, I mean, you look at the NASDAQ now. NASDAQ, in fact, I was going to do this right before the demo started. I thought I probably should buy my short position now because that's the time to do it. And now the S&P is actually down. It was up 42 points. Now it's down 2, right? That's what happens as a result of derivatives expirations. It is a one-day event. And everybody shuffles, and that causes prices to move. If you have to get something done now, you're going to overpay for it. And all the parties in the market are going to know. That's why this stuff matters so much. So the next big benchmark is the 18th through the 20th. The 20th is also quarterly in S&P and a bunch of others index rebalances. Well, we'll look to see where the supply and demand are then. So now we've got two pieces of the puzzle. The last piece of the puzzle would be divergences. Where are the divergences? I wrote about this morning, and if you looked at your desk or your dashboard, you would see that there was only one sector that had divergence. But this is way late in the cycle. You don't want to be buying at the very peak, right? It'd be much better to buy when it rises over 5 and supply is falling. Then when it begins to peak, that's when you want to be out. And I think real estate's underperforming today. But if you look at the rest of the sectors, I've got a retailer's portfolio, very strong move here, and you're going to have some outliers. And supply came back down to 50%, but it's peaked. This is SaaS. You can build any kind of portfolio. Small caps peaked, total market peaked, utilities, which have been a great performer. There you go. It's peaked as well. Those are flat lines. The supply and demand are kind of identical, and it's a little above 5. It's not a bad place to be. But clearly, we're not at the beginning of another surge, barring some dramatic change. There could be an input that would change it. Semiconductors falling, right? You can look all the way over across your dashboard, and now you know what. I mean, no one else really knows this, right? You can't get a good look at the 30-day trend in the money any other way effectively. And this is a really effective way because it reflects the rules of the market. We use regulations that govern how trades get executed to understand supply and demand. And so you can look all the way across the market and say, well, it's really difficult. But at 7.1, could momentum still work? Yes, it could. And here's that's broad, looking at broad sentiment, context, looking at divergences. I set up a trade in SoFi before the market opened today. And because you have 100% probability of producing a 2% return. Doesn't mean it'll happen. It's just all historical. But if you bought it somewhere close to 760, would it be better at 735? Statistically, no. Do I like it better if the price comes to me? Yes, it feels better. Right? You say, it's down half its volatility, better place for me to buy. Statistically, it makes no difference. Mathematically, it makes no difference because you don't know where the volatility of 4% is going to come. Well, look at it today. You can make 10% on it today, right? Just all you had to do is just follow the math and do no more thinking than that. I think I closed that window, didn't I? No, here it is. Okay, so it's at whatever it is now. It's 822. But so it's up 10%. All you had to do is right when the market opened, it was right at the upper edge of the recommended range. So just a mathematical calculation. You could put in you could limit out. I set my limit out at 799, but that's what you want to do. That's what you wash. It doesn't always work out this way. But you've put the whole picture together here. You know what the broad market's doing. You know what the supply-demand balances are, over $55 trillion of market cap, give or take. You know what the trend is likely to be. You've used math to help you take a return like this could take you years to produce, right? In a buy and hold portfolio. If you took the average price in the S&P 500, not the benchmark, just you take all the stocks and you create an average price. We do it behind the scenes. It's only up 8% over the past year because there's a lot of stuff that doesn't follow the benchmark, right? And so it's not that great. You could do that in one day using mathematical probabilities. That's what you want to do. Now, shifting to the last, what's ahead? You always want to be thinking what's coming. The market is not. We start over every day at square one. And every day is a new day. There's a continuum. Months matter. Monthly options expirations matter. The way money flows into and out of the market from 401k contributions, required minimum distributions to all the people who have to take those. When do those things occur? They're going to have an effect on the market. Do people have a bias toward the equity market or toward fixed income? And when does that stuff tend to happen? Beginnings of months. So, beginnings, middle, and ends of months are all pretty important. It's the way the machinery of the money works. And so just beware of those things. Looking ahead, and Henry and I might just talk about this at the end, but here's what I look at. So we're at the end of the month. We've had a great momentum run. We've had it's an unusual market where you have a steep turn in the market that is completely reversed and head scratching. We have massive data changes, 800,000 jobs. I'm still amazed that it's one of the biggest changes ever. And I've been modeling the Bureau of Labor Statistics jobs data for years. I used to be on CNBC routine. Rick Santelli can't have guests like me anymore. They've changed what he can do. But I used to be on with him all the time covering productivity, and we would talk about the jobs data. So I'm very familiar with the data, and that is a massive outlier, and yet no one even paid any attention. It's just startling to me. But I look at this data and say, there may be an opportunity for a short here that produces a pretty good return. Look, it's a risky thing to do. I like to use SPXL. I shorted the market yesterday and took 1%. And I put in a long hedge, SPXL as the hedge, just a small piece. So, 2.5 times short, 1 time long to protect myself, because what if I'm wrong? I mean, I don't know I know what the central tendency is, but on any given day, the volatility can fool you. That's as it's designed to do. And so then once the market started to move in the short direction, I dropped my hedge. You lose a little bit of money on that, who cares? And I took the 1%. I'm happy with that. If you can do that over and over, it's stress-free. It's so much better than all the gut-wrenching things that happen as stocks rise and fall. So I may do that again here. I'll see where the market goes. If it gives up all its gains, then I've probably missed the opportunity. But I know that these conditions contribute to that possibility. If the market finished very strong today, I would say that the other party who is supplying whatever the buyers need today may have to sell something. Okay, well, I know what the supply-demand balance is, and maybe there's an opportunity to make money that way. And I'm always thinking, like the weather forecasters, I'm thinking 5 days out. Where are we 5 days out? Not for short-term trading, that's where it is. Long-term, it's a different matter. You could modulate your long-term portfolios, and I think Henry's going to talk about this, using these data too. Much longer cycles, using, when demand peaks, reduce your exposure to equities. When it bottoms and begins to rise, put more money to work. Then you avoid all of this. Because if you can go from here to here, you're way better off than the people who bought and held through this, right? So that's what I've got. I'm going to stop sharing, and I'll hand the baton here to Henry. And Henry, you can now give something that's actually valuable.
That's excellent, Tim. Thank you. No, I'm gonna toss some questions, and we have a handful of people with questions in the chat.
Okay.
And I wanted to focus on first. I wanted to talk about earnings, because we've had a couple. You mentioned Dollar General, and then also obviously we talked about NVIDIA. And I can share my screen, or if you want to, while I'm talking, you could pull up NVIDIA or Dollar General. And I want to talk about those short volumes and the reliability of those short volumes. And then I'm going to ask another question about behaviors.
Okay.
But obviously, NVIDIA with 60%, see, what I'm looking for in my daily process is I'm looking for a handful of things to give me alignment. I'm looking at that broad market sentiment to align with an individual name, to align with our context. And I'm looking for a reason, a context for risk off if it's a short position, or risk on, or the lack of a context event to continue a momentum move forward. What do you, we tend to say, earnings distort the outcomes, and it distorts the data. If we look at both NVIDIA and Dollar General, they've behaved as expected. NVIDIA topping out really high short volumes, going into earnings with with sentiment that's sort of hitting the roof and ready, pretty confident that it's turn around. I'm cherry picking 2 examples. Dollar General is the same thing. But what would you say? Because this wasn't the case. If you tried to trade these sort of things maybe a year ago or 2 years ago, when we had more of a consistent sort of bull market, you just get beat up by these things. So can you speak to that a little bit?
Well, I think that trading stocks around earnings is a dicey endeavor. Now, people love to do it. The very first customer that bought our data, we're actually not selling to this group at present. Look, I'm a capitalist. Would I do it? Yeah, I've had some conversations with folks who have reached to that audience, but they were hedge funds. And they told us we make 2/3 of our returns. I've mentioned this many times to this group. Of our returns, 2/3 of our returns betting directionally around earnings, but they can make such large bets that their bets become self-fulfilling. A company could beat and raise and get clocked because hedge funds are not using sell-side consensus, what the analysts say. That is so yesterday's data. Hedge funds are buying all the data. They know all the supply chain data. Credit card data is 25 years old, but everybody's consuming that. Satellite images of parking lots. They know everything. And then they can make an 8 times levered bet. You look at this and say, well, Dollar General, if this was where we were looking yesterday and then today before the market opened, you looked at this, you would say, well, it's probably going to drop. I could short that. Yes. And you'd have been correct. But it's a dicey bet. It does not consistently pan out. We have tried it internally. We've modeled, okay, under these conditions, which direction will the stock go? And we cannot get a central tendency out of it. There are other things that we do that have much more merit. We run a model for public companies that is pretty effective at telling them what will happen. My brief comment would be careful with these things. I don't know if I'm answering the question you're asking.
No, that was excellent, because what I don't want to turn our users on is to, hey, here's two sort of two coin flips that worked in our favor, when
Right.
Statistically, if we backtest things, this isn't our bread and butter. Our bread and butter is divergence, and a strong broad market sentiment, and taking the 1-2% gains, because eventually one of these will miss. And the same way that maybe you're up 10%, you'll be down 10% on one immediately.
And even here, there's a great illustration of the power of market structure, of market structure edge to help you. If NVIDIA is at 1 and supply has not fallen, well, why own it? Now you could buy and hold it for this whole time, from July all the way to the beginning of August. But your money didn't produce anything. Why not take that money? Because alpha, risk-adjusted return, producing a return that outperforms the market, requires doing things that the market isn't doing. You can't own something the market doesn't own. We all own the same things. So the only way to outperform the market is to own them at different times than everybody else. I realize that clashes with we are browbeaten with the idea that buy and hold is the only way to go. You can't time the market. You can't outperform the market. That is BS. So I'm sorry. It has been proven over and over to be false. It is a narrative that money managers love to promote because it helps them justify the fact that they don't outperform the benchmark. Well, you can't time the market. We just got to buy and hold. Well, what if you need the money when NVIDIA is down 67%, right? So all this time, you could have done something else with your money. When demand begins to rise and supply does not keep pace, now you can buy NVIDIA and take those gains. When supply rises above the trend, get out. You've kept all those gains. What difference does it make what price it is? All that matters is, where did I buy it and where did I sell it? And what kind of a return did I produce? So instead of, you could say, well, in August, NVIDIA is up 28% or whatever it was. Yeah, but you could do that in 6 days. That is a better return. That's the whole idea of using math to help you produce a good return. SoFi, same thing. I mean, if you could get this return in SoFi in so short an order, well, why wouldn't you? Now you can go find something else to do with that money to produce a return. Maybe it's shorting the market. That's difficult and dangerous to do. But you're using supply and demand to help you. This is the Hicks rule right here. Steve Hicks, longtime user. You got a stock at 10, and supply decline day over day. What's the probability of a good return? All other things being equal, very high. And then you take that return and do something else with the money.
Tim, let me ask you another question, and then we may shift to using Edge for portfolio management.
Yep.
In our big tech, or our in our big tech portfolio, I want to take a peek at behaviors.
Okay.
2 days ago, all of big tech, 90% of big tech was active investors, which we know is a very small percentage of the trading volume. Now it's a preponderance of fast trading. Talk about the mechanics of that and the reliability of those behaviors. I mean, the basics is, we know that fast traders don't want to own anything. So when we see a move, if we're waiting on a move and we say, well, there's still some active people out there that want to drive the price up, well, they're going to accept those orders. And then this is my thesis on this. And then when we see these fast traders, man, that's a lot. I mean, I like to see even more than this on fast traders. I want to see like 95% is just a home run. But to the point is, what is your perspective of that, of behaviors and utilizing them? I have to bulk them. If it's one off, I don't quite trust it as much. But what's your perspective there?
Number one, don't depend on them for predictability. It's not like one behavior has an advantage over another, because it's one of the core principles of regulation national market system. The market cannot give preference. If you're going to offer an exchange, alternative trading systems have customers. They're regulated slightly differently, but the market has to share all of its customers and prices. That's the way the market works. A NASDAQ listed stock doesn't trade at the NASDAQ, it trades everywhere. The NYSE floor has only 9% of volume, and the DMMs on the floor are required to be 10% of that, 90 basis points, designated market makers. My point is, it doesn't matter what your behavior is, you're not better or bigger than somebody else, but you have a different purpose and time horizon. Passive money needs the benchmark, it needs beta. Fast traders have an investment horizon of a day or less. They're only after changing prices. That's it. And that, to Henry's point, what this tells you is that prices are changing in this group. Active money is bottom-up motivated. This is about story, financials, performance, competitive advantage, all those things. Awesome, Benjamin Graham style bottom-up investing. The trouble is there are only 30% of assets under management now, functionally. 70% run on models because they're a bunch of closet indexers. They're less than 10% of volume. These guys are 50% of volume. So it's just that you will know, you can look at it and go, okay, well, most of big tech is going to have changing prices. As Henry said, probably an opportunity. In tech right now, you can make money on volatility. Okay, well, that's good to know, but they're not going to help you. I'm going to go chase the fast traders. They're smarter, they're better informed. They know all the data. They consume all the data. There are 16 stock exchanges. All of them sell at least two proprietary data feeds, and these guys buy all that. They buy all the data, which means they have much better pricing data than you do. So you look and you go, oh, SoFi's at 759. Well, they know already that it's changed, right? They're a step ahead of you, and they know which direction it's going. You can't compete with that. That's why we're telling you, don't try to do that. Use supply and demand and a different horizon. If I buy close to the close, I may be trying to leave early tomorrow because I know machines are going to change the prices, and I know what the advantage is, right? I know which direction it's probably going to go, long or short, and I just want to take that gain. Or it could be 3 days. Sometimes it's that long. I don't like to hang around if you make 2%. That's how I would describe it. There's more to that story. I don't want to chew up any more time. We've only got about 6 minutes left. Henry, I didn't leave you much time.
No, I'm just lobbing questions. Unless anybody else has, I'll give you dealer's choice here. You talked about at 7. It's the smart money is either hedging their long-term portfolio. That's a methodology for hedging the long-term portfolio versus just selling assets or selling something. Do you want to talk about that, or do you want to talk about next week's context, risk events, risk off events, and how that affects the data? Those are two options.
Let's see if we can answer both. Henry, that's a really good point, actually. If you can, there are three ways to make money. You can buy things that you believe will rise, you can sell things that you believe will fall, or you can buy the gap between them, right? That's volatility. But to Henry's point, you could do a very low risk. If you look at the broad sentiment and you say, well, now the market is likely to have a propensity to decline, you could hedge your portfolio, hold your long-term portfolio, but now maybe you buy SH, which is a one-time short S&P 500. Not going to move very much, but if the market declines, now you've added to your returns, and you can always pull it. And you're not doing this randomly. You know what the condition is. And there are two things here to note. Number one, clearly demand is peaked. Doesn't mean the market will fall. And the whole supply chain has changed. This is very unusual to go 15 days around 50. Usually it changes every 5 days. Well, I'd look at that and say at some point that's going to have an impact. If demand stalls as it looks like it's doing and supply is this high, what will prices do? Fall. Well, maybe I want to hedge. SH is very easy. Those kind of things do work pretty well. If I'm going to short the market, I often hedge myself with a little, I believe the market's going to decline, so I'm going to put whatever. I'd like to trade about $50,000. So I'm going to make a $25,000 bet that the market's going to decline. All things like this are bets, but it's a high probability wager. But I'm going to protect it with a $10,000 long position. And if the market moves against me, I can drop my short and take the little gain in the long or even out so I don't lose money. If I'm right, I'm going to immediately pull my long hedge as the market starts to tip over. Then you take your gains and you're happy with it. Don't try to repeat it and then lose all that money that you made. But those are some great ways to add a little return to your longer term portfolio. So what was the other one, Henry? I've forgotten.
Well, so,
what's coming?
We had the larger earnings with NVIDIA yesterday.
Yep.
We have expirations, month-end expirations. So we know that that's a risk event. Between expirations and forthcoming next week, those
jobs
are
data.
Jobs data. So, so just talking about what's coming. I mean, those are the context events that are coming up. But reading into that from, combining both the data and our context coming up, what can we expect?
That would be it. By the way, internally, every Monday we have this discussion. Our head of client services on the corporate side, a guy named Brian Late, he's got a master's in economics, and that's part of his job. And we say, Brian, what are the things? What do we need to know? What are the tradable events? We tell public companies there are red flag days when you shouldn't be reporting earnings or other important news because it will be overwhelmed by macro events. And I would say that's the big one. Jobs data. We backed 800,000 jobs out. Is there going to be a ripple effect in these jobs data? Is the market prepared for that? The market is prepared for Jay Powell to cut rates. Well, may not matter. I mean, if prices are so high that no one can afford to buy things anyway, there's only one thing that needs to happen. Prices have to come down. We're seeing it here in Steamboat. I mean, back up 6 months ago, you couldn't buy a house here, and the houses on the market were $10 million. Now there are a bunch of homes around 7, it's 5, 6, 7, and they're cutting them. It was one cut down $750,000. We're seeing price reductions everywhere. It's happening all over the country. Prices are starting to come down. It's a natural thing. That's what always happens when you have inflation. Prices rise, and what always follows inflation? Deflation. It doesn't matter what the Fed does. If anything, the government is undermining the Fed by continuing to pump money out into the market. But prices, that's what always happens. The tulip mania of what was that? Barry Norton, you might remember better than me. 1636, is that what it was? Tulip bulbs shot to the moon, and then what do? They reset. That's what prices do, and they need to do that. So I don't know when that's going to happen. And my point out of that is everybody's looking at the rate cuts coming at the September Fed meeting, and I fully expect they will cut rates 25 or 50 basis points. I think it's terrible that a central bank has that much control over the supply and demand of labor and capital. But the jobs data, to me, that you beware of. And if you're risk averse like I am, be out of the market then. Don't be trading around Friday. Let's see what happens. You won't miss an opportunity. All that matters is, do you have a high probability for a return, long or short? That's the only thing we want to think about. Okay, that's all I got. Thank you.
That was excellent. Anybody else out there that has questions or clarifications can always message Brian or I, and I'll let you close this out, Tim.
Any comments? Any questions? Anybody want to weigh in? No? Okay. Well, we'll do this again next week. Let's see where we are. We'll be right before the jobs data, and we'll want to look at the supply demand data and see where we are, and see if we're right about this potential short opportunity. Yeah, I think they only call Barry Norton, you're doing it all the time, but for me, it's only a 3 or 4 times a year event where I'm going to say, okay, because I'm not smart enough like Barry to do it consistently. It's got to be a really good opportunity. But I think we've got one here. We'll see, won't we? Enjoy the long weekend.